RBI, ECB, FPIs, and your stock market playbook for 2025 to 28. So, India just pulled out one of the biggest economic playbooks in recent memory. The government and RBI are doing seven things simultaneously: cutting rates, relaxing FPI rules, offering tax breaks on government bonds, launching ECB incentives, pushing public sector divestment, all to bring billions of foreign dollars into India. Why? Because at 6.4% GDP growth last year, India wants to re-accelerate to 7.8% and then hold 7% throughout 2028. But here's the question you actually care about. What does all of this mean for your money, your SIPs, your stocks, your fixed deposits? Stay with me because in next 20 minutes I am going to break down every single policy, explain every term in plain Hindi English and tell you exactly where smart investors should be positioning themselves right now. Coming to section 1, let's start. So, let's see the big picture. So, why is India doing this? So, let's see the stage. India's GDP growth was 6.4% in FY 2025, that is financially 2025. That sounds good and is good, but our chief economic advisor or CEA believes India has the structural capacity to hit 7.8% in near term and sustain 7% throughout financial year 2028. But to go to get there, we need fuel, and that fuel is foreign capital. Think of India's economy like a startup. You have a great product. The fundamentals are strong. Young population, digital infrastructure, manufacturing push, domestic consumption. But to scale fast, you need investors to put money in. So, GDP. Quick explainer is that GDP stands for gross domestic product. Simply put, it is the total value of all goods and services produced in India in a year. When GDP grows at 7%, it means our economy is producing 7% more wealth than last year. Why does foreign capital matter? Then the answer is like when foreign investors brings dollars into India, a few things happen. First is that the rupee gets stronger or stays stable. Second, that Indian companies get access to cheaper global capital. Third is that stock markets and bond markets get more liquidity. Fourth is that RBI has more foreign exchange reserves, meaning more financial firepower. So, India's macro strategy right now is attract the world's money, deploy it productively, and grow faster. Okay, so next we have the RBI's toolbox, that is the seven big moves. So, move one is that voluntary retention route, that is VRR expansion for FPIs. So, first let's talk about FPIs. FPI stands for Foreign Portfolio Investors. So, these are global funds. Think BlackRock, Vanguard, sovereign wealth funds from the Middle East, pension funds from the Canada and Europe. They buy Indian stocks and bonds. So the RBI has expanded something called the voluntary retention route or VRR. Simple explainer is that under the VRR, if a foreign investor commits to keep their money in India for a minimum period, typically 3 years, they get relaxed investment limits and can buy more Indian government bonds than normal investors. And why is this brilliant? Is that because it brings in sticky capital, not hot money that flow in and out in 3 months. So, long term committed capital that stabilizes our markets. The expansion means more allocation limits and meaning more global money can come in under this route. An investment insight for you will be that when FPI inflows increase into bonds, bond yields fall. That's actually good for equity investors because when bond yields fall, stock become relatively more attractive. Second move is that tax relief on gilts, that is GILTS. So the GSEC play. It is a GSEC play. So now this is a big one. Gilts or GSECs are government securities. So these are bonds issued by the Indian government to borrow money. They are the safest investment to India because they are backed by Government of India. The new proposal is to offer tax relief on income earned from gilts for certain foreign investors. So, why does this matter is that currently foreign investors pay withholding tax on interest earned from India or Indian government bonds. So, by reducing or waiving this tax, India becomes far more attractive compared to US treasuries or European bonds. So, if a foreign fund can earn 7.1% on a 10-year Indian GSEC with tax relief versus 4.5% on a US treasury, why would they not buy India? For you as an Indian retail investor, this means India's borrowing costs may actually decrease over time as demand for GSECs rises. So, lower government borrowing costs is equal to more fiscal space for infrastructure, welfare, and growth spending is equal to good for the economy and your investments. Move 3 is the ECB incentives, that is, external commercial borrowings with time bound incentives. So, ECB, the external commercial borrowings, this is when Indian companies borrow money from outside India, from foreign banks, international bond markets, or overseas investors. So the government is offering time-bound incentives for companies to raise ECBs. So these include relaxed end-use conditions, higher borrowing limits, and possibly interest subvention for certain priority sectors like green energy, manufacturing, and infrastructure. So, simple analogy being that your friend in the US is willing to lend you money at 5% interest, but your local bank is charging 9%. So, if government also says we'll subside 1% of that foreign interest, you'd obviously borrow from abroad, right? That that's ECB for companies. So, investment insight is that companies that successfully raise ECBs at low global interest rates will have lower financing costs, boosting profitability. And we need to watch for announcements from infrastructure companies, green energy firms, and large cap manufacturers. Move 4 is FCNR B deposits, bringing diaspora money home. So, if you see, FCNR is the foreign currency non resident deposits type B. So, this is a deposit account that non resident Indians, that is NRIs, can open in India in foreign currency like US dollars, British pounds, or euros. So, the government is planning incentives to make FCNR deposits more attractive. This could mean higher interest rates, longer permitted and tenures, or tax benefits. So, why does this matter is that India's NRI population sends home roughly 100 to 120 billion dollar every year in remittances. So FCNR deposits are a way to keep more of that money in Indian bank system for longer. So more FCNR deposits is equal to more forex reserves for RBI is equal to stronger rupee defense capability. So for you, this doesn't directly affect equity investors, but a stable or appreciating rupee reduces the risk for foreign equity investors, which means more FPI flows into Indian stocks. Move 5 is that public sector unit divestment, that is unlocking PSU value. So the government is pushing PSU, that is public sector unit, divestments, and strategic sales. So, PSUs are companies where the government holds a majority stake, that is ONGC, uh, BHEL, NTPC, HAL, and Coal India. So, the idea is to either one, sell minority stakes to the public and foreign investors via OFS and IPOs, and two, or in some cases, like fully divest and privatize. So, why this matters is that when PSU gets listed or diluted, they become more efficient, accountable, and market driven. So, foreign funds that want exposure to India's energy, defense, and infrastructure sectors get a channel to invest. So, investment insight for you will be that keep a close eye on PSU stocks, especially in energy, defense, and infrastructure. Pre-divestment, and these often get a re-rating, that is NTPC, HAL, Mazagon, Doc have already shown this playbook. So the next wave could include PSU banks, BPCL, or insurance companies. Move 6 is the FPI investment in equities, relaxed sectoral limits. So, the SEBI and RBI are working together to relax FPI investment limits in certain sectors, particularly insurance, defense, and infrastructure. Because currently, FPIs face sectoral caps. For example, in insurance, they can only hold 20% of a company, and these limits are being revisited. So for like more FPI access is equal to more demand for Indian equities, which is equal to potential re-rating of those sectors. So quick note on FPI flows and your SIP is that when FPIs sell like they did aggressively in late 2024, the market corrects. When they buy like early 2025, markets recover. And your SIP is actually designed for this volatility. So when FPIs sell, your SIP buys more units at lower prices, and that's the power of a rupee cost averaging. Coming to move 7, and the last final move they took is the macro stability, the CA 7.8% thesis. So, finally, the rashing of micro framework. So, the chief economic advisor has laid out that with continued fiscal consolidation, that is deficit reduction, inflation control, that is RBI's rate cuts working, and supply side reforms, that is PLI schemes, manufacturing push, capital account management, India can sustain 7.8% growth in short term and 7% throughout FI, that is fiscal year 2028. So this is the bull case. It's not guaranteed. It needs global cooperation, no major shocks, and strong execution. But the macro setup is as good as it's been in a decade. Now, let us move on to the next section, that is what this means for markets. Equity markets, like should you buy more? The honest answer, like it depends on, mm, what can I say? Yeah. So it depends on your time horizon. So for short term traders, I can say that you can like short term in the sense the traders under 1 year. So the markets are still digesting global uncertainty, the US tariff situation, the Middle East geopolitics, the China's recovery. So Nifty at around 24,000 to 25,000 levels faces resistance. So don't expect a straight line up. And for medium term investors, that is 1 to 3 years, the macro setup described today is genuinely bullish for India. FPI inflows returning, rate cuts by RBI improving corporate earnings, PSU re-ratings, infrastructure spending, all of this should re-rate Indian equities. Target Nifty at 28,000 to 30,000 by fiscal year 2027 is a reasonable bull case. And for long term SIP investors, that is 5 plus years one, continue. Don't stop. In fact, this is a great time to increase your SIP if your income allows. So, the 7 to 8% GDP growth story compounding over 5 years is extremely powerful for equity returns. And if you ask me where to invest more, then I could say that um, you can invest more in the banking and finances because financials because the rate cut environment is good for NBFCs and private banks. Second, the infrastructure and capital goods, like the government spending cycle is strong. Third, in the defense PSUs, because the FPI relaxation plus order books will give you re-rafting potential. And also in IT sector, because if US recession fears fade, IT recovers fast. And also the green energy, because ECB incentives directly benefit renewable energy companies. And coming to debt markets, that is bonds and gilts. So, with tax relief on GSECs and RBI rates, this is a great time to consider. So, gilt mutual funds for tax efficient bond exposures, long duration debt funds when rates fall, long duration fund NAV rises, and also HDFC, SBI, ICICI, GSEC funds are good examples. So, key insight being, if RBI cuts rates by another 50 to 75 BPS over the next 12 to 18 months, long duration bond funds could give you 10 to 12% returns comparable to equity with much lower risk. And the tax note being, under the new tax regime, debt fund gains are taxed at your slab rate. Keep this in mind when calculating post tax returns. And if you ask about the gold, is it still relevant? Then I would say that gold has a phenomenal run in 2025, but with FPI inflows expected to return to India, rupee likely to stabilize, the urgency for gold as a hedge reduces slightly. That said, 5 to 10% gold allocation in your portfolio is always sensible. Use SGBs, that is sovereign gold bonds, if they reopen, and they give gold plus 2.5% interest plus capital gains tax exemption on maturity. Next, coming to your action plan, let me give you a concrete action plan based on three investor profiles. Profile one being the beginner, that is under rupees 5 lakh investor. Priority should be that don't try to time the market. So, first point is keep your SIPs running, increase by 10% every year. Two is that add 2000 2 to 5k per like add your 2 to 5k per month to Nifty 50 index fund, because or Nifty 500 index fund. And third one being open the NPS National Pension System account for tax savings plus long term equity. Fourth is to put emergency fund in liquid funds, so not in bank, saving at 3.5%. And fifth is to consider 500 to 1000 per month in a gilt fund or bond exposure. Okay. And coming to profile 2, that is the intermediate investor from 5 lakh to 50 lakh portfolio, priority should be optimize and diversify. So review your portfolio, reduce overexposure to any single theme. Second, add international fund exposure, that is US S&P 500 index, like 10 to 15% of portfolio. Third is to consider switching 15 to 20% of debt allocation to duration gilt funds. And fourth is to look at PSU themed funds for next 2 to 3 years cycle. Fifth is to review your insurance. Term insurance and health insurance must be sorted before investing more. And SIP top up. So, if macro improves as expected, consider SIP top up in Q3 2025. So, so do it. And next, profile 3, the experienced investors who are from 50 lakhs plus portfolio, the priority should be position for the next cycle. So first being infrastructure plus capital goods sector, that is 15 to 20% thematic allocation. Second being the banking sector, that is private banks at reasonable valuation with rate cut tailwind. Third being considered direct GSEC purchases through RBI Retail Direct for 7% plus risk-free return. Fourth, to evaluate NRI or FCNR structure if you have family abroad for currency diversification. And fifth is to real estate exposure via REITs. So, not physical property for liquid and yields. Section 5 is the risk to watch. So, what I would say is that, um, see, uh, I don't want to be just a bull. So, here are the real risks you want to monitor. Risk 1 being that global recession in US or Europe. If US enters recession, FPIs will pull money out of all emerging markets, including India. So, this can cause sharp market corrections. Then, risk two is that oil price spike. So, India imports 85% of its oil. So, if crude hits $100 plus again, India's fiscal math breaks and higher inflation, wider current account deficit, and rupee weakens. Risk three being monsoon failure, agriculture affects monsoon failure because agriculture affects 15% of GDP and 60% of population's income. So, a bad monsoon means food inflation, rural distress, and slower rural consumption. Risk 4 being global interest rate reversal. So, if US Fed stops cutting rates or reverses, the carry trade argument for India bonds weakens and FPI flows could reverse. Mitigation being diversify globally, maintain liquid buffer, and don't over leverage. And coming to the closing, the India story. So here's the bottom line. India is the middle of one of the most deliberate, structured economic reacceleration attempts in its history. So the policy toolkit is comprehensive. The macro fundamentals, demographic dividend, domestic consumption, digital economy, manufacturing push are genuinely strong, and the challenges are real too. So the global headwinds, execution risks, and fiscal tight ropes. But for long term investors, this is the country to be invested in. So, not because of hype, because of mathematics. So, a 1.4 billion people economy growing at 7% for 10 years creates extraordinary wealth. So, your job as an investor is simple: stay invested, stay diversified, increase your SIP every year, understand what you own. That's it. The government is doing its job. Now, let it do its job. I leave you with a thought from Warren Buffett that in short run, the market is a voting machine. In the long run, it's a weighing machine. So India is being weighed and the scale is tipping in our favor. If you found this video helpful, subscribe, hit the bell icon and share this video with one friend who needs to understand India's economic strategy and the story. And drop in the comments which policy did you find most interesting, and are you increasing your SIP or staying the course. See you in next one. Jai Hind.